Before plasticizers ever touch the open market, they start here as flawless, raw chemical output. But the moment these virgin materials leave the factory chute, their value is dictated entirely by the mechanics of global supply chains. Those distribution networks are massive, and right now they are undergoing a period of structural adjustment as shipping lanes and regional demand cycles shift. To navigate a logistical apparatus of this size, commodity traders and B2B analysts rely on hard data to make split-second procurement decisions. That brings us to the specific window we are analyzing today, the fourth week of August 2026. Cutting through the noise of this specific week requires precise intelligence, sourced directly from the Polymer Bazaar desk report. To access that intelligence instantly, traders are leveraging an industry-first AI-powered WhatsApp chatbot. By messaging a dedicated number, a user can query real-time DOP pricing and receive an actionable response in under 5 seconds. Integrating this real-time data into a procurement strategy allows converters to react to Q3 and Q4 pricing shifts as they occur, rather than trailing behind the trend. Looking at the macro energy landscape, crude oil prices are actively softening across global markets. This downward shift in crude is directly tied to a measurable reduction in immediate supply disruption fears out of the Middle East. Yet, despite cheaper oil, importers and traders cannot relax. Underlying logistics and localized feedstock volatility remain highly unstable. This conceptual chart illustrates the core trap of the current market. Plasticizers are caught in a psychological friction zone, squeezed between a top-down demand slump and a bottom-up floor of feedstock costs. Expanding that top-down pressure, we see a severe, synchronized seasonal demand slowdown across China and India. In China, late August historically triggers a predictable transition period across the manufacturing sector. Chinese domestic and export markets are currently navigating a confidence gap, with buyers actively adjusting inventories in anticipation of the traditional peak season, while supply levels remain structurally sound. Moving to India, domestic downstream offtake is heavily subdued, matching the sluggishness seen across the region. This Indian demand slump is a direct result of the monsoon season's tail end, a weather pattern that historically halts major construction and infrastructural polymer use. Combined, these regional lulls enforce a rigid holding pattern. Buyers and suppliers are locked in a standoff, waiting to see exactly where prices will settle. We can see the exact mechanics of this standoff by looking at this dashboard for dioctyl phthalate, or DOP. The line graph tracking spot quotations shows a distinct, albeit mild, downward slope. Over the last week, DOP spot quotations have witnessed this minor downward correction. That drop tracks perfectly with the cautious buying interest from domestic and regional converters we just observed. The resilience of DOP pricing, despite this demand drop, is a direct function of its primary feedstock, 2-ethylhexanol, or 2EH. Spot values for 2EH remain firm, inserting an unyielding baseline underneath DOP production costs. While 2EH holds its ground, other upstream margins, such as phthalic anhydride, remain stable to soft. It is specifically this firm 2EH cost floor that prevents suppliers from offering any aggressive downside movement on DOP. Swiping over to the dashboard for dioctyl terephthalate, or DOTP, the line graph reveals a completely flat, stable trendline. DOTP has maintained relative stability when directly compared to DOP. This resilience is driven by steady demand within its specific alternative applications. However, just like DOP, DOTP producers are heavily anchored by the exact same firm 2EH feedstock trends. For primary plasticizers, the gravity of raw material replacement costs has neutralized much of the buyer's leverage, resulting in stagnant, range-bound pricing despite anemic demand. Transitioning this dashboard to evaluate secondary plasticizers like DINP and DOA reveals a different trajectory. These materials are experiencing significantly sharper downward price pullbacks. This drop is occurring because purchasing activity in this sector is heavily restricted to absolute immediate necessities. Specific downstream user segments, such as flooring producers and flexible film units, have essentially halted all bulk acquisitions. Major downstream segments, specifically PVC pipe and cable manufacturers, are directly contributing to the specific demand vacuum by withholding their usual large-scale volume orders. We see this hand-to-mouth procurement strategy deployed most aggressively in the Indian Bazaar. specifically within the manufacturing hubs of Mumbai, Morbi, and Ahmedabad. Converters in these key locations are keeping their procurement statuses minimal, currently refusing to commit to bulk inventories. Instead, these buyers move. Until these localized manufacturing hubs gain enough confidence to shift from hand-to-mouth buying to bulk purchasing, secondary plasticizers remain vulnerable to deeper bearish trends. Pulling back to a master view, this timeline synthesizes the broader market trajectory. Notice the projected downstream order flow curve beginning to ramp up steeply as it crosses into September's peak season buildup. This visualizes the exact central paradox we are currently in. Downstream converters are hesitant to build long positions today, yet strong feedstock support limits any real price drops from suppliers. In the immediate short term, near-term price fluctuations will persist, but the downside space remains heavily cushioned by those raw material costs. Looking at the medium-term outlook, the impending September demand recovery will dictate the next major trend. Historically, even a slight improvement in downstream PVC order flow triggers a rapid shift in overall Bazaar sentiment. Because of this impending shift, the official Polymer Bazaar desk recommendation is clear. First, avoid panic selling and do not chase high premiums in this turbulent window. Second, converters must balance their minimal inventories now, proactively capturing early opportunities ahead of the demand curve. Market participants who navigate this psychological friction zone today will be positioned to capture optimal margins when the September rebound hits. To maintain your edge, utilize our AI WhatsApp chatbot for instant DOP updates and subscribe for immediate market notifications.